Assalamu alaikum and good afternoon everyone. Welcome to my presentation. First of all, I would like to thank you all for visiting my YouTube channel. I am Mohammad Rezwanul Haq, ID nong 2010837144, studying in University of Rajshahi. I am pursuing a 4-year BBA program and currently enrolled in 3rd year first semester under Faculty of Business Studies in Department of Banking and Insurance. As part of our educational requirement, I have prepared this presentation topic. Today I am going to discuss about a very interesting topic for which all of us business graduates and economics enthusiasts should know. The purpose of my presentation is to discuss about hot capital, the bane of emerging economies. Let's begin. What do we mean by the term hot capital? In general, a hot capital flow refers to a brief influx of capital into an economy, usually for the purpose of speculative investing. This type of investment is typically held for less than a year, sometimes only lasting weeks or even days. Regrettably, large volumes of global inflows, particularly of the speculative hot capital type, can pose macroeconomic risks, as was evident in the events that unfolded in Asia. Now we will see influence of hot capital from the aspects of different countries as well as post-COVID-19 pandemic. The influence of hot capital in Southeast Asian economies. In the early to mid 1990s, an influx of capital poured into Southeast Asian economies due to their impressive growth rates. Much of this capital was invested in the stock market, real estate, and dubious infrastructure projects such as the world's longest bridge, the tallest office building, and yet another automobile plant. As a result, these economies experienced an overheating phenomenon leading to skyrocketing stock and real estate prices. By 1996 to 1997, it was not uncommon to pay over $12,000 per month for small apartments in Hong Kong or Singapore. The speculative asset price bubble became a significant concern. However, by the late 90s, the US economy, fueled by the new internet and productivity advancements, started to recover and was soon followed by signs of improvement in Western Europe. Investors, wary of the overvalued assets in Southeast Asia, began to withdraw capital from the region and redirect it to the USA and Western Europe. This sudden exhaust of capital, known as a hot capital outflow, was a major factor in the currency crisis that affected the Southeast Asian economies in 1997 to 1998. The impact of hot capital in Mexico. In 1994, Mexico faced a crisis similar to the one experienced by the hot capital. During the 1990s, Mexico launched an ambitious privatization campaign along with significant fiscal and monetary reforms that gained global admiration. This resulted in record capital inflows, primarily from the USA, as a reward for the country's progressive macroeconomic policies, which enabled President Clinton to pass NAFTA, which means North American Free Trade Act. The central banker Mr. Miguel Manguera was known for his strict opposition to any form of monetization, representing financial prudence and discipline. The macroeconomic outlook appeared promising and more capital continued to pour in. However, in 1994, Mexico's safe haven status was shattered due to the demand for autonomy by the Chiapas Indians, disruption of national transportation, to political assassinations and financial scandals at the highest levels. This sudden loss of Mexico's safe haven status, crucial for capital flows, led to a dramatic outflow of hot capital in the last quarter of 1994. The impact of a hot capital outflow on domestic interest rates is illustrated in figure above. As you can see on the figure, the vertical axis shows interest rates and the horizontal axis shows loanable funds. When the interest rates rises up I0 to I1, this blue colored supply curve moves to the left side and it shows hot capital outflow, and this is a demand curve. Let's move to the text. The sudden departure of hot capital causes a significant spike in domestic interest rates as seen in the sharp increases from I0 to I1. This phenomenon was prominently observed in late 1995 in Mexico and during the Southeast Asia financial crisis of 1997 to 1998. The sharp rise in domestic interest rates has a detrimental effect on domestic capital investment as borrowing costs become prohibitively high. The influence of hot capital in Iceland and Singapore. In 2006 to 2007, Iceland faced a major crisis as a result of an influx of carry trades driven by low interest rates. In the USA and Japan, this led to a surge of short-term investment in Iceland's high-yielding government debt, with investors borrowing funds at low rates and investing them in Iceland. When the economy began to overheat, the capital quickly fled, causing the krona to weaken. On the other hand, Singapore managed to avoid a similar currency crisis in 1997 to 1998 through prudent monetary policy led by Dr. Richard Hu, the head of the Monetary Authority of Singapore. The country allowed its currency to float on two occasions to manage the influx of funds and also implemented domestic monetary contraction to minimize the destabilizing effects on its stock market and real estate sector. This approach helped Singapore mitigate the impact of large inflows of funds and maintain stability. The footprint of hot capital in China. China's August 2015 devaluation and the concerning macroeconomic news about its slowing economy led to a significant outflow of hot capital not only from China but also from much of Southeast Asia into the USA and to some extent into Singapore, which also prides itself on being a safe haven. Typically, when one country's currency devalues due to a sudden hot capital outflows, neighboring countries often have to follow suit. Groups of neighboring countries often export similar goods and services due to similarities in their factors, endowments, labor skills, and resources. So, when one of these economies finds its currency devalued due to a capital outflow, it also finds its exports suddenly cheaper, which in turn makes the exports of other neighboring countries suddenly more expensive. As a result, they too have to weaken their respective currencies to prevent their export markets from suffering. This is a form of contagion. China's slowdown combined with that of the Eurozone had a highly negative impact on countries that were major exporters of infrastructure related commodities such as copper, rubber, zinc, wood, and oil. Economies such as Brazil feel the brunt of the China slowdown. In September 2015, just one day after Standard and Poor's downgraded Brazil's credit rating to junk, the Brazilian real plummeted as capital poured out. A desperate attempt by Brazil's central bank to inject $1.5 billion to sell US dollars and buy back its falling currency proved to be futile. Widespread government corruption, along with an unsustainable budget deficit or GDP ratio of 9%, lead to the inevitable decline of the real. All the gains from the long commodity boom that had made the Brazilian economy a favorite among global investors were lost. Hot capital outflows, India 1991 and 2013. In 1991, India found itself in the midst of a severe balance of payments crisis. The country was unable to afford all of its necessary imports as it did not have enough foreign exchange US dollars to cover the cost. To make matters worse, the dissolution of the Soviet Union, which had been India's largest export market in the 1980s, drastically reduced India's export revenue and source of foreign exchange. Additionally, the 1991 Gulf War led to a sharp increases in the price of oil, one of the India's main imports. As a result, India's foreign exchange reserves plummeted from $1.2 billion in January 1991 to less than half that amount by June, leaving the country with only enough foreign exchange to cover about 3 months' worth of essential imports. The rapid and vicious outflow of hot capital further exacerbated the situation despite attempts by the Reserve Bank of India to prop up the Indian currency by selling US dollars. The effort proved futile. In desperation, India sought a loan of $2.2 billion from the IMF using 67 tons of its gold as collateral. This move, which effectively depleted India's entire gold reserve, caused widespread outcry and ultimately led to the outsitting of the weak government in power at the time. The new government, led by Prime Minister P.V. Narasimha Rao, implemented much needed reforms that set the stage for the supply side framework of the future Modi government. The announcement from the US Federal Reserve in 2013 that it was considering ending its $85 billion a month bond buyback program triggered a significant capital outflow, with India being a major recipient of the hot capital from the US and the Eurozone during the 2017 to 2013 period. As interest rates in the US remained at rock bottom, carry trades poured capital into India, driving up its property and stock markets. However, the US eventually announced a plan to taper off its money printing, leading to 15% drop in the Indian rupee and a rush of capital back to the US. Despite the implementation of capital controls by India and Brazil, the currencies of several emerging economies including India, Indonesia, Brazil, South Africa, Vietnam, China, Taiwan and Thailand suffered significant losses as capital outflows returned home. The influence of hot capital after post-COVID-19. After experiencing near-zero interest rates in the USA, the Eurozone and Japan during the COVID-19 pandemic, there is a persistent fear that once rates begin to rise post-COVID, the influx of capital will return to these three major economies, potentially leading to another taper tantrum. Nations that had previously attracted this capital are uneasy about the possibility. This was most recently exemplified by the Russian ruble, which plummeted by almost 40% following Russia's invasion of Ukraine. The hot capital fled Russia as carry trades returned to their perceived safer home countries. As investors exchanged the ruble for more stable currencies, the value of the ruble dropped dramatically. Concluding remarks. When volume of blood in a human body increases beyond optimal, it causes high blood pressure. Likely sudden inflow of hot capital in an economy creates volatility in financial markets and brings in economic instability. When hot capital leaves, it also puts the economy in a shock, creating liquidity crisis in banks and exchange rate instability. As global economy is interconnected, hot capital moves from one economy to another, and the investors of hot capital wanted to earn short-term profit on interest rate differences and on anticipated exchange rate shifts. However, in a capital-hungry economy, if hot capital is used properly, can bring in positive impact in the economy. So this ends up my presentation. Thank you everyone for investing your valuable time. If you find this video informative and helpful, please give your thumbs up, share it with your dear ones, make comments, and please do subscribe this channel. Thank you once again.